Welcome back, traders! It's time for our weekly market analysis, where we will explore some crucial data that could have some significant impact on the forex market and other financial instruments. So let's get started. Firstly, we eagerly await the Fed interest rate decisions from the FOMC. In their last meeting, the FOMC participants opted to maintain the current Fed funds rate, giving them more time to assess the economy's progress. However, there was a faction of officials who advocated for 25 basis point rate increase, considering inflation still exceeds the 2% goal, and the tight labor market. Most officials are complementing rising borrowing costs later this year. Should the Fed implement a 25 basis point rate increase, it may potentially strengthen the US dollar, as higher interest rates typically attract more foreign investments. Now, let's shift our focus to commodities. A rate hike might weigh on gold and silver prices, given their inverse relationship with the dollar. As the dollar strengthens, commodities priced in dollar become more expensive for foreign investors, possibly leading to lower demand and dip in their prices. Moving on the euro area, we have news about their interest rates. In the previous meeting, the European Central Bank rate raised by 25 basis points due to concern about persistently high inflation. Looking ahead, there's speculation that they might consider an even more substantial 50 basis point increases after July. An increase in euro area interest rates could potentially strengthen the euro, as higher rates tend to attract foreign capital seeking better returns. European indices might experience some volatility, possibly leading to a short-term dip as investors adjust to the new rate environment. Now, let's discuss the United States Durable Goods Order (MoM). While May 2023 saw 1.80% increase from the previous month, there is an expectation of a minus 0.8% decrease this month. A decline in durable goods order might raise concern about economic growth, potentially putting downward pressure on the US dollar. However, the impact of the stock market can vary. If the decline is limited to specific sectors, we might see selective adjustment in the stock market. Conversely, a widespread decline in durable goods order could lead to broader market volatility. Next, we have the US GDP growth rate QoQ2. In Q1 2023, the US economy surpassed expectations, expanding by annualized 2%. However, the anticipated growth rate for this quarter is 0.10%. A negative GDP growth rate could weaken the US dollar, as it might signal economic contractions. US indices might face a sell-off as investors adopt a more cautious approach toward the economic outlook. However, keep in mind that other factors can also influence market sentiment. For gold and silver, a negative GDP growth rate could strengthen their safe haven appeal, potentially driving up demand and prices. Finally, let's look at US Core PCE Price Index (MoM). In May, it increased by 0.3%, and by the end of this quarter, it's expected to rise by 0.30%. The Core PCE Price Index is a measure of inflation, and any increase in this index could heighten expectations of higher interest rates from the Fed. Should the Fed indeed raise rates, it might boost the US dollar as investors seek higher returns in dollar-denominated assets. Thank you for joining us on this exciting journey throughout the world of finance. We will be back next week with more market insights. Until then, happy trading and keep exploring.